Okay, so back to the question.
Mm.
A company has paid the following dividends for the past 5 years. So we have 10.4 to 14.5. So let's go to Excel and calculate the growth rate. So you do this equals, I forgot one thing, power,
Mm.
because we are looking at a square root function. So you write
Mm.
power. I forgot to put power. So
Mm-hmm.
you start with equals power, open brackets. Then you start with the current dividends, which is 14.5,
Mm.
14.5 over the previous dividend, which is 10 cents, right? Comma. Then you like to say that a square root, you just write 1 over. Now, how many years? We said we have got 4 past years.
Mm.
1, 2, 3, 4. So, the power 4. So, you put a 4, then close bracket, enter. So, you are getting this one. Now, after you get that one, the formula says, if you go back to the formula says minus 1.
Mm.
Minus 1. So, now I have to deduct the 1. So, here you write equals this, the answer that you have just arrived at, minus 1. So, you are getting this. Then you convert to percentage. So multiply by 100. We can just click on Excel and percentage. So the growth rate is 10% to the nearest. But let's put it to two decimal places to be accurate. First has to be the two decimal places. Yeah. So make sure your answers are the two decimal places so that you don't get them wrong in the exam.
Mm-hmm.
Not one, because one will give you 10, but put them to two decimal places. So that's the growth rate. Have you understood?
Yes.
Okay. Okay. There's another. So for 2 minutes, I'll give you this exercise. You have to do it in Excel. So assume
Mm.
the following data has been assembled concerning the net dividend per share paid in the last 5 years from 2021 to 2025. So these are the dividends here that are paid. So calculate the growth rate. Can you do it? 2 minutes is enough
Okay.
in Excel.
Mm.
Have you found the answer? Hello?
Hello, I'm on it.
Have you found the answer?
No, I'm on it.
You are delaying. It should be 1 minute done. Don't forget the power equals power. Are you having challenges? We should revise. Hello? Are you having challenges? Hello.
Hello.
Have you found the answer?
Yes.
How much? What's the answer?
Okay, let me put it into decimal places. It's 10.30.
Okay, 10.30. Okay, let me try it. So we have the current dividend is 1.48. So it's
Mm,
1.48 divided by 1
mm,
to the power 1, 2, 3, 4 to the power 4. Okay.
mm.
So is equal to power 1.48 over 1, comma 1 over 4. That. Then you subtract 1.
Mm.
So that's it. Take this matrices. 10.30.
Mm.
Okay, that's correct. So that's the easiest way of calculating it. What are the limitations of the dividend valuation model overall? So the limitations, we are looking at this. Yeah. So the first limitation is that growth in earnings is ignored. So we don't focus on growth in profits, we focus on growth in dividends. Input data may be incorrect, i.e. market price. So you might use the wrong market price. And also it ignores taxation. Those are some of the limitations. So that's the rule on dividend valuation. So where are we coming from? We're saying we're looking at the cost of equity, which is calculated as KE equals DO 1 plus G over PO plus G times 100. However, if you're not given the growth rate, we calculate the growth rate using Gordon's growth and the historical method. So I've calculated the two. Let's now look at the second method of calculating cost of equity, which is the capital asset pricing model. So the capital asset pricing model calculates the cost of equity using this formula: KE equals RF plus RM minus RF times beta, where KE is the cost of equity, RF is the risk-free rate, RM return on market. So return on market is the rate available in the market. Then RM minus RF is the equity risk premium. The difference of the two is known as equity risk premium, the extra risk that you take. Then B is the beta factor. So what is the risk-free rate? So risk-free rate is the minimum return required by all investors for an investment whose return are certain. There are some investments which when you invest in, you know their return. Good example is government bonds and government gilts. All these are government forms of borrowing. So all these have a risk-free rate because we are certain of the rate that they are going to be charged. To understand the CAPM better, we need to understand the portfolio theory, which says that a business will be able to reduce risks if it invests in various businesses. So if you invest in various businesses, you'll be able to reduce risks. Now in portfolio, there are two types of risks. You have systematic risks and unsystematic risks. So what is systematic risk? Systematic risk is a risk that cannot be reduced by diversification. What we mean is that no matter how many businesses you have, this risk will still be available. Then unsystematic risks are those risks which you can reduce by diversification. For instance, if you have a business such as maybe you sell ice cream, during rainy seasons people cannot buy ice cream, so you can start selling umbrellas. So it means this business is not performing, the umbrella business will start to perform. So that is a systematic risk. It means that a risk which can be prevented when you have got several businesses. However, systematic risk will still be there because you need to, for example, borrow money sometimes to run your businesses. So this risk will always be there. You still need to pay maybe funds to city council. You need to pay taxes to city council. So those are systematic risks. No matter how many businesses you have, you still have to pay them to incur those risks. So that's a graph which shows systematic risk. If you look at this horizontal line, which is shaded, this is systematic risk. We mean or market risk. This risk is reduced by diversification. However, systematic risk will just be reduced. It can just be reduced, but it's not completely eliminated. So if you see this box, which is not shaded, it's known as oh sorry, let me go back. I'm saying this line which is shaded is the systematic risk or market risk, because no matter how many businesses you have, it will still be there. It will always be constant. But systematic risk or unit risk will be reduced by diversification. If you have several businesses, it will be reduced. You can see the risk is going downwards like that. So that's what we mean. Now let's look at the meaning of beta. If you look at the Kaplan formula, it has the beta. Here you can see the beta factor. So this beta factor is used to measure systematic risk. So what does it mean? So we are on the meaning of beta factor. Now if your beta value is 1, it means that the business has the same risk as the market. So what we mean is that whatever is happening on your business and the market is all the same. You have the same risks. If the beta is greater than 1, it means your business risk is higher than the market. So your risk as a business is pervasive than what is happening on the market. Then if beta is less than 1, it means business risk is lower than the market. So your risk is lower than the market. So let's demonstrate using this. We have got this example which says calculate the risk-free rate is 4%, while the return on market is 9%. Calculate the cost of equity if A, beta is 1, B, beta is 1.5, and C, beta is 0.8. Now let's start if beta is 1. So we said KE equals RF plus RM minus RF times the beta factor. So RF is 4 in our question, RM is 9 minus RF 4, then times 1, right, as a beta factor. So this is 5. 5 times 1, 5. 5 plus 4, 9. So remember we said if beta is 1, the risk is the same as the market. So you are going to get the cost of equity which is the same as the market rate because beta factor is 1. However, if beta is greater than 1, we said you are going to get a higher cost of equity than the market. So your business is more risky than the market. So the same formula, we just change on beta, 1.5. So 5 times 1.5, it should give you like 7.5 plus 4, 11.5. So it is true that if beta is greater than 1.5, your business is more risky than the market. So it's getting a higher return than what is expected on the market. If beta is 0.8, it's lower than 1, it means the business is less risky than the market. So you can see if you multiply 5 times 0.8 is 4, 4 plus 4, 8. Now you can see we are getting the cost of equity which is lower than the market. Have you understood?
Yes, but can you go back to another side? I want to ask.
This one.
Yeah. I just want to try to link in the graph here.
Okay, this graph.
Like systematic risk and unsystematic risk, market risk. Total portfolio, it's going up, eh?
Yes.
And I want to ask you one thing. ndekuti on that level musimu
Mm.
ikakazira kuti uli ndi systematic risk yokha. Is it possible a business to have only a systematic risk without ma unique risks?
It's possible if you don't diversify.
Ah, okay.
Yeah.
And the next slide here.